Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. I want to thank everybody for joining us this weekend. My name is Robert Kuhn. We're here every Saturday, 10 to 11. If you're catching this on the podcast, thank you for listening to the podcast. If you're listening to this show outside of our home market, which is the Chicago area, we're located in Naperville, Illinois. Understand and know that we can work with you. We continue to try to increase our distribution of the radio show. So if you're hearing my voice, know that we can work for you. Again, my name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. I am also the host of Destination Retirement. Our job as a financial advisory firm is to make sure that we are providing investment strategies that can deliver positive returns, principal protection in all markets, even down markets. Those strategies do exist, and we talk a lot about those, and we're going to get into taxes today. We're going to get into the markets today. We're going to get into the volatility today. We're going to get into interest rates. So we have a lot to talk about and get to. So if you'd like to set up a conversation with myself, you can call Paige. That phone number is 630-492-1912, 630-492-1912. We do have a lot of people that reach out to schedule an initial consultation. Sometimes we have in-person meetings. Sometimes it's a phone call. Sometimes it's over a Zoom. It really is what is best for you. So if you do get a voicemail, know that we will get back in touch with you, but you can also call again immediately so we can get you on the calendar. Again, 630-492-1912. So a couple things that I want to go over initially. I found a really interesting statistic this week, and the market is, does it repeat itself? I mean, oftentimes, you're going to find it doesn't repeat itself, but it rhymes, and it's very close. And I saw a quote this week, and it was titled, "Are we in a matrix?" And obviously that's a attention-grabbing line, and they got me, and I continued to read on, and I'm really glad that I did. In 2007, July 17th, 2007, the S&P hit a top. We had a 9.5% correction once we hit that top. Then we had a full recovery. So markets dropped almost 10%. We had a full recovery. September 18th, 2007, we had the rates, our interest rates were cut, and then the market collapsed. So let's fast forward to 2024. Again, July 17th, 2024, if you can believe it, we had a top in the S&P 500. We had a 8.5% correction, actually 8.6 to be exact. We experienced a full recovery, so the markets did recover. And what is going to happen on September 18th? Are we going to see rate cuts? Are we going to see the Fed's cut rates again? And then what is ultimately going to happen to the market? That is everybody's question. I guess it could be different this time. Maybe the dates just are by chance, and maybe the markets continue to run. So I'm certainly not calling for a major correction. But it's so interesting. And I think so much of the markets, when you look at kind of our conversations that we're having with individuals recently, there's a lot of fear. There's a lot of fear in the markets. There is a lot of unknown. And I understand why. When you look at, kind of, where we're at today, and you look at the news that we're getting today. I mean, we just had a jobs number that was revised down by almost 1 million jobs. I mean, that is just again, that has to be concerning. It has to be concerning to individuals when we live in a 24-hour news cycle and we're seeing all of these, little, one sentences, two sentences, tweets. And I think it's causing a lot of concern for individuals. And especially what I have found are individuals kind of in their 50s, mid-50s, 60s to, 60. I look at who reaches out, and a lot of times they're in that 55 to 70 range, and I look at most individuals are kind of in their early 60s to mid 60s, and we're finding more and more people who are reaching out who just aren't certain that they have the correct investment plan in place. And one of the things that we pride ourselves on the radio show is we're not here selling anything other than knowledge, wisdom, education. And do we hope that you become a client? Well, of course. I mean, we want to grow our business. We want to help. The only way we grow our business is by helping individuals. And so the last handful of weeks, I've really taken a step back on who has reached out. And, generally speaking, you have two types. You have the listener that listens to the show pretty religiously or somewhat on a regular basis, and they've listened to the show for an extended period of time, and they just finally decided that it was time to reach out. And then you have the listener that listens one time. They happen to be in the car on a Saturday. I say something that piques an interest, and they reach out. And so we look at kind of who is reaching out. It's kind of the 55 to 70-year-old individual. There's a life event that's about to happen. It could be, they sold a business, or they're getting ready to sell a business, or they're getting ready to retire, whether it's, imminent, or whether it's, 2 to 3 to 4 years down the road, or they just retired. So those themes are pretty, consistent with everybody. But it's also just individuals who have uncertainty. They're just uncertain that their plan will deliver what they are looking for. And they're not looking for an idea. They're not looking for one investment. And we have a lot of those. We talk an awful lot about, the bank notes. I mean, the bank notes are, there's a reason why we talk a lot about them. It's because they're great. In my opinion, they're great. And we believe they're one of the most cutting-edge investment strategies available. When I can share with somebody that you'll have a note that's, a bond that's backed by, the largest banks in the most, financially secure banks in the world, and you can get, 12% or 13% or 11%, as long as the indexes that note is tracking are not down, 40%. That is a very appealing story for somebody. And so I always think it's my job to give kind of targeted or very specific pieces of investment advice just to let you know what's out there. But what we're finding is individuals really want kind of a CFO of their personal financial situation. They want somebody that can look at everything, and the advisor may not manage everything, but they can manage the other, investment professionals that they're ultimately working with. And I guess I'll pat myself on the back here, and kind of take some credit to that, in that, we're doing something right on the radio. We're doing something right in letting individuals know that you have to look at the world differently today. We're not just here selling, annuities. Like 80% of radio shows are just pitching, these annuities. And not to say that the annuity is bad, but, how does it ultimately fit into your plan? So I really appreciate everybody who's reached out, and especially here over the last 2 to 3 weeks, that, they're just looking for something more. They're looking for their personal CFO. Somebody that has been in the business for an extended period of time, someone that can decipher different investment strategies in a way that, most listeners can't, not because we're smarter, it's just because this is our business and we have a 25-year head start on you, because all marketing is great. All marketing is great, or else they wouldn't spend the money on it. And we can, cut through things in a way that you just simply can't. And so if you're looking for kind of that lead person to be your personal CFO of your family business, and again, it could be $100,000, it could be $20 million of investable assets. It doesn't matter the amount. But if you're looking for that type of a trusted relationship, then we're going to be a good group to talk to. So 630-492-1912, 630-492-1912. And it's not lost on me that, people over the last handful of weeks are reaching out in greater numbers because of what happened, 2 Mondays ago, where the markets dropped. And we saw a significant, drop in the market, and then, it certainly has come back. But yeah, there's just more uncertainty and more unknown than I've ever experienced in my career. But that doesn't mean that that's bad. That's okay. I mean, I think the markets we're going to just see massive volatility. We're going to see a lot of big ups. We're going to see a lot of big downs. And as I was explaining to a listener who called in, and we had, an initial, talk on kind of what they're looking for and a little bit more on what we offer, I love volatility. And if the markets were to drop 20 to 30% tomorrow, personally, I would like that, because, if I'm looking selfishly for my own investments and my, what would be good for my, family, I would love to see a huge market drop. Now, for clients who are near retirement or, in retirement or just retired, that would be very, very worrisome. So much of the, what is going on in the market and how it affects you is where you're at in your life cycle. And I saw a phenomenal quote, and we're really going to start to expand on this. To make money in the market, you have to have a growth mindset. You have to have a growth mindset. But to keep that money, you have to have a defensive mindset. And the challenge is most advisors can't do both. They don't do both well. And most individuals, candidly, don't do both well. And that's one of the things that I believe that, sets our firm aside or apart from others, is that we try to be experts in both. We try to be experts in growth, and we try to be experts in defense. And we talk about both. And we're not just, going to talk about defense. We're not just going to talk about offense. And so, I continue to try to share that message on the radio, that you have to have both, because yes, the markets are very worrisome. There's the risk is potentially, off the charts. And, we have to make sure that if you did see a 20% correction, a 40% correction, that you would be okay. Not only would you be okay, because the answer isn't just to sit and wait. Unfortunately, 9 out of 10 advisors, that's what they're going to say. Just sit and wait. You're going to be perfectly fine. Well, think about that. If we lose 20%, what is it? The next 26 or 25 to 26% of gains are just getting you back to even. That's not okay. And again, I'm convinced, just based upon the people that I know in the industry, and these are very successful advisors at very big firms, and they're, I would consider very, very close friends. They invest their personal assets differently than they recommend those clients to invest, because so many advisors today are making recommendations to their clients on how they should invest in a way that's easy for them to scale their personal business. And again, we're uncovering everything in this industry, and I'm okay with that. We'll never name names, right? So we'll never call anybody out, but it's my job to do it. I love that I get to do it in many markets throughout the United States, and hopefully we're going to double and triple and quadruple those markets, because we have a message and we're here to help individual investors. So 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Yes, the host of Destination Retirement. If you're hearing my voice, we can work with you. We are headquartered in Naperville, Illinois, suburban Chicago. We do have a national client base, which is why we run the show in multiple markets. So if you are hearing my voice, we can work with you. Give Paige a call. 630-492-1912, 630-492-1912. Set up your initial consultation. It doesn't cost anything. It's just a conversation with me on what you're doing, what you like, what you don't like, what's keeping you up at night. And really, the main reason that I ask everybody when they reach out is, why are we here? Why are we talking? What is wrong, or what inefficiencies do you think you currently have inside of your portfolio that would make you reach out to somebody that you didn't have a previous relationship with? And I give a lot of credit to individuals who take that next step to make a phone call. Now, I'm very unassuming and we are laid back as far as having conversations, and as I am on the radio is exactly how I am when you reach out. But we are very serious, and we are very serious about not losing money, and we are very serious about the conflicts of interest in the financial advice business. And so understand when we do talk that, I'm going to try to identify, why it is that your current portfolio, your current advisor, or if you're managing the money on your own, why they have led you to reach out to somebody new. And it's important for us to know that so we can, identify that and try to address that concern. Because sometimes I become a robot in this industry. It's just numbers. And I have to take a step back and remember that there's somebody behind those numbers. And there's a family behind those numbers. There's a family that has, put away and invested and worked hard, and now, is either retirement's on the horizon, or, they just retired, or they're already in retirement. And we have to make sure that we are doing all that we can to protect your life savings, your life work. Not only just because of the numbers and making sure that it can provide you whatever, those resources need to provide you, but look at it. And this is where I was going to, just looking at, not just, individual portfolios as numbers, but psychologically and mentally, that, it can cause a lot of angst, a lot of stress in, when the markets, become volatile. And I don't think we've seen anything yet. I mean, I do think, long term, of course, the markets are going to make money. I mean, the markets are up. I mean, the trend is always up. And that's probably never more evident today with, the evolution of passive investing. The markets are going to go up. But, can you stay solvent? Can you stay, relaxed if we do see a year or two or three of significant drawdowns? What does that do ultimately, to your plan? So those are the things that, we try to talk about when we're looking at the radio show and we're looking at topics to talk about. We talk about topics that I think are very relevant to everybody. And we try to give you, an issue, and we try to give you an answer. And obviously, past performance isn't indicative of future results. And investments that I talk about on the radio may or may not be suitable for you. And there's always, risks of every investment, and we just have to, go over those. But when I see headlines like, one of the presidential candidates wants to potentially increase capital gains rates to over 40%, that is something that we have to plan for. Again, this isn't, me being political in any way. It's just if that particular party gets into office and they are actually able to raise taxes to that rate, that could be catastrophic for a lot of individuals who haven't planned for that. And you have to plan proactively. It's like when you look at business and you look at, companies, when companies have lines of credit, are backed by a bank, you don't want to be trying to raise capital or secure funding when you need it. I mean, that's just not the time to do it because banks recognize that. And there's a reason why that the company or an individual is looking for capital. It's because there's a problem. Now, they're going to say everything is perfectly fine and they're going to paint a rosy picture, of course, but the time to look for capital is not when you need it. And we have to look at that as far as individual investors as well. The time to plan for potential what-ifs isn't when those what-ifs are happening, because generally they're already priced into the market. A lot of the market moves are priced in, 3 months, 6 months, 9 months, 12 months before you actually see the move. So the question that I have for you is, if capital gains rates do increase and if they do go up to almost 50%, what does that do to your portfolio? What does that do to your current situation? And again, the most overlooked area of financial planning is tax planning, tax mitigation. And I say this over and over and over again, and I want you to hear, it's not how much you make, it's how much you keep. And if we can reduce your taxable income significantly, well, you're just going to keep more. And if you're with a big bank, if you're with a big brokerage firm, unfortunately, the tax strategies are at a minimum. They just don't have the most robust tax strategies. The KCP Energy Fund, for example, if you invested $100,000 last year, we were able to reduce your taxable income by almost $90,000. Active income, passive income. Think about that. $90,000 per $100,000 invested. Now, I'm not a CPA. I can't provide tax advice. So best practice is always talk with a tax professional before you do any investment. But the tax strategies of the energy fund are very black and white. And it was what we were able to reduce your taxable income last year. So it may not be 90% this year. It may be 80%. It may be 85. It may be 75. It may be 70. Maybe it is again 90. But think about that. An investment vehicle that could reduce your taxable income last year by almost $90,000 per $100,000 invested in a strategy that has targeted annual distributions in the 15 to 20% range. That's a 1 to 5 year investment. So that is a strategy, and we'll talk about why and how we can utilize that here in a second. But if you have interest in that strategy, let's talk about it. If you sold a business, if you're a high wage earner, if you sold property, if you exercise stock options, if you have highly concentrated stock that you're going to pay significant capital gains on, or if you're not selling, we deal with this a lot. A lot of the Magnificent Seven, the tech names, a lot of people have owned a lot of those names, and they have significant capital gains. And they're not selling because they don't want to pay those capital gains. Well, what if we started to dollar cost average out of those names, take some of that money and invest it in a fund that can greatly reduce your taxable income? Well, that's phenomenal. That's something to take a look at. So 630-492-1912, 630-492-1912. We can have an initial conversation about that, because you look at like the RMDs. So many individuals that we're talking with are looking to take money tax efficiently out of qualified accounts. And if you have an IRA, you know that any money taken out of that IRA is taxed as ordinary income in the year you take that money out. If you are forced to take RMDs, well, you don't necessarily want to possibly take that money, but you have to take that money. So what about, again, taking some of that money out in a tax-efficient way to where we could mitigate some or all of that additional tax that is due from that additional income? Those are things that, as an independent fiduciary, we have access to looking at and sharing with you those types of strategies. If you're with a big bank, if you're with a big brokerage firm, you just aren't going to have access to that. If you have a quote unquote independent type advisor, there's still somebody that is monitoring the products that they have, the investment strategies that they have or allow their advisors to invest in. And again, it's just a pay per play. Say that a bunch of times. Pay per play situation where the banks, the brokerage firms, the independent advisor, independent advisory companies. It's my belief that they want to receive compensation for putting their investment strategy on the shelf for their advisors to recommend. We don't have to worry about that as an independent. There is no shelf. We can look at anything. Now, that can be good and bad, but we have that flexibility. So if you have money and you're over 59.5 in your IRA and you want to take that money out proactively, tax efficiently, and mitigate some or all of that additional tax due on the income, let's have that conversation, because the energy strategy is something that you may really, well, I'm certain here in the Midwest that most individuals have very little exposure to anything in the energy space other than individual, company stock, Exxon, Chevron, et cetera. And you don't recognize the tax advantages of investing in energy. Now, again, energy investing, it doesn't mean that it's not without risk. I mean, please don't hear that. But when we look at how we're able to mitigate that risk and we're able to create an investment that we believe is a very predictable investment that gives you significant tax advantages, it's just something that, we want to make sure that we're getting the message out. And then also Roth conversions. The Roth conversion story is, second nature to most people now. But the advantage to the Roth conversion is you're taking an asset that is ultimately going to be taxable and moving it to an asset that you're going to pay the taxes on at that time, and then you're not going to pay taxes on the gain if the tax laws stay the same. Well, if you have $1 million, $100,000, whatever that number is, and you want to convert, well, that's additional income tax for that year. So it's going to bump you probably to a higher bracket. Well, what if we could do that and take some cash money and invest it in the energy strategy that, again, can offset that additional tax due from that conversion? That's just taking it to the next level. Anybody can do a Roth conversion. You can do a Roth conversion. You can Google Roth conversion calculator and see it. That's simple to do. But the real good advisors are going to say, okay, let's do the conversion, but let's take some cash money and invest it in this strategy so we can negate some or all of that additional tax that is due from the conversion. So I know we talked about a lot about tax in this segment, but it's important. It is one of our greatest differentiators as an advisory firm, is bringing to the table strategies that can greatly reduce your active or passive income, W-2, 1099, it doesn't matter. So I know there's a lot of real estate investors out there that invest because of the tax benefits. Well, those distributions are very, very low in many instances today, and those tax benefits are okay, but they're not what the energy space can provide. So 630-492-1912 if you want to have that conversation. 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent fiduciary. Yes, we are a fiduciary, registered investment advisory firm. We do believe in financial planning, and we also believe in providing strategies that can deliver positive results in down market, strategies that can protect principal in down markets. I think that is the job of an advisor. I don't think it's talked enough about, but we talk a lot about that on the radio show, and I want to thank you for listening. If you hear my voice, we can work with you. We are headquartered in Naperville, suburban Chicago, but we do have a national client base. If you'd like to set up a time to have an initial consultation, please do that. You can call Paige at 630-492-1912, 630-492-1912. She will set that up for us, and we will learn a little bit more about what you're doing and what you're looking for and what you're not getting. That is obviously the most important, especially in this market. Talked a lot about taxes last segment. Normally we don't spend an entire segment on taxes, but it is important. It is very, very important to understand that we can reduce your taxable income. It's not what you make, it's how much you keep. And strategies exist that you're probably not aware of in the energy space. So give Paige a call, 630-492-1912. Let's have that conversation. So markets, you look at, the job market, and you look at, as I mentioned last segment, we had a pretty significant revision down in the jobs to the tune of almost 1 million. Why? I mean, I don't know. It's so many theories why, and we could probably go down, many rabbit holes, and we won't do that, on the radio show today, but it certainly is interesting why and how that happens, especially in 2024. But I think the job market holds a key to the economy's future. And, recent data certainly suggests the U.S. economy is still moving toward a soft landing. But I think investors must stay cautious because cracks are appearing in the labor market. And that is something that is very concerning. Everybody wants interest rates cut until they start to cut them. And if they're cutting them, there's a reason why. Generally, it's softness in the economy. And it's not something that individual investors, individual advisors are planning for. Again, as I mentioned last segment, corporations, when they need money, that's not the time you want to try to find money. And individuals the exact same way. When the market is starting to become very volatile, that's not the time you want to start planning for it. So whatever a soft landing means, I think a soft landing is going to mean something different to everybody. I don't even know how you quantify what a soft landing is. I mean, I guess there are parameters, but what's a hard landing? And it's, Wall Street's motto is always to convince investors that everything is going to be fine. And advisors in particularly are always telling you, don't worry about it. It's going to be higher, down the road. And, that's the case. Generally speaking, that's always been the case. But you have to remember, if you lose money, you have to use future gains just to get back to even. And those are gains that you missed out on. And so if you don't think the markets can stay sideways for an extended period of time, you're making a mistake, because if you had bought Microsoft in 2000, it took you 12 years just to get back to even. 12 years to get back to even. So, yes, Wall Street and many advisors' expectations of a soft landing for the economy, they still assume, a relatively durable labor market that supports consumer spending, and that ultimately will hopefully, allow for a soft landing. However, there are trends and there are cracks in the economy that are starting to show. And we have to make sure that we're planning for that. And I want you to think about your portfolio. And I want you to simply think that if the markets do drop 20% in calendar year 2025, what do you have in your current portfolio that you could point to that would protect you from losing or experiencing those losses? Or even better, what do you have in your portfolio that if the markets do drop 20%, that you have an investment that can still generate positive returns? If you cannot answer those questions, then your advisor is, chances are almost with 100% certainty, you don't have those inside of your portfolio. Because I would like to think that if you reached out to our clients and you asked them that question, they could point to the protected growth strategies that we have inside of their portfolio that can still generate positive returns, even if the markets are down 10%, 15%, 20%, 30%. We have those investments, and you need those investments. You don't know that you need those investments until it's too late, generally speaking. you have to plan for volatile times down markets when the markets are good. Because financial markets have somewhat, I kind of believe that they have, and in some instances I don't believe that they have, but they've restored a sense of order following, the recent volatility. And if you look at the latest data on inflation, retail sales, jobless claims, there have been a level of reassuring investors that the economy is still moving towards, kind of that soft landing of slower but steady growth, that the Fed can take a measured approach in easing interest rates and bringing interest rates down. But, and there's always a but, right? What if that isn't the case? Because one thing I've learned in 25 years of being in this industry is what you don't expect to happen happens more times than you care to think it could happen. And I just have to stress to individuals that now is the time to plan for those what ifs. So, if you just go back to the basics, consumer spending fuels about 2/3 of the U.S. economic output. And while the average U.S. household is still spending robustly, consumers are increasingly living paycheck to paycheck. And so when I talk about cracks have emerged in the labor market amid declining new job openings and a modest rise in continuous jobless claims, those are things that, start to worry us. And those are things that we have to become cautious about. So yes, there is a cause for caution. And if I have one major complaint about the financial advice business for the average client, and I look at an average client or an average investor as somebody who may have a couple $100,000 of investable assets to, $10 to $15 million. Generally, that is the space that, while you think the advice that you're getting is so customized and it's the most cutting edge, it's not. That's my belief. It's just not, because I see those clients. I see those clients who have a couple $100,000, and I see how they're invested. And then I see the client who has $10 million of investable assets. And they're almost the identical strategy, just dressed up a little differently, with a little bit better of a sales pitch, or a little bit better of, a little more customization. But at the end of the day, they're the exact same thing. And that goes back to what I said earlier in the first segment, was individual investment advisors generally are, again, it's my belief that they are investing their personal assets, their immediate family's assets, significantly different than they are recommending that their advisor or their current clients invest. And it's not so much in the upmarket strategies, because generally those are just going to do what they do. It's in the protection strategies. It's in the strategies that can protect or generate positive returns when the markets are negative. And if I have to give a 30-second elevator pitch on why we're different, if I'm riding up the elevator in our office to the second floor where our office is, and somebody says, "Hey, what do you do and why are you different?" Now, I'm in an office that there's a, we won't go down that rabbit hole, but there's a lot of advisors in our office that we are in. Now, they work for one specific company, and I love that company. I think that company is phenomenal. But somebody asking that in an elevator is a realistic situation. Here's what I would say to them. We work with investors who want to have a level of predictability inside of their portfolios that if the markets are down, that they know what bucket of their money, what sleeve of their money, what allocation of their money will generate positive returns even in down markets, or preserve principal even in down markets. So yes, we work with individuals who want to generate positive returns even when the markets are down for some of their money. That is all we do. And when you look at how advisors are managing their money, I would almost guarantee that they have a lot of those strategies inside their portfolio, but they're not recommending those strategies to the clients that they're managing and providing, so, quote unquote, unbiased financial advice for. And the reason why, in my opinion, is because it's very hard to do at scale. It's very hard to do for the masses. It's very hard to do to implement those types of strategies when you have thousands of clients or hundreds of clients. And so what they look to do is, that's why Wall Street, just simply states you have to use a balanced portfolio, equities and bonds. And it's like, well, okay, how has that done for you over the last 4 years? How have the bond market, short of recently with interest rates ticking down, and yes, we've seen some of the bond losses over the last 4 years are now being recouped, but how has that worked for you? I mean, that's cookie cutter at its finest. And an advisor will slap a fee on that portfolio, and then they will do that to hundreds of millions of dollars, and then their income continues to increase. They're living a very, very great lifestyle, but who's stuck? Well, when the markets drop, the answer you get is, oops. Well, they're not going to say sorry, but in essence, it's oops, sorry, don't worry about it. The markets are going to come back. Well, of course the markets are going to come back. I mean, that's not even up for debate. Long term, the markets are going to be higher. But where are you at in your life cycle? Are you retired? Are you near retirement? Are you, in retirement? And then more importantly, you have to use those future gains just to get back to where you were. And that is what we have to talk about. So we have to turn the conversation from the market's coming back. The markets always come back. Always. Always, always, always. But look at the opportunity cost that you're missing out on by having to recoup those losses. And so those are the challenges that I think that need to be addressed. Now, for some of the money, if it's an aggressive type strategy, if it's a very targeted type strategy, then that just is what it is. I mean, that's just how it's going to be. But when we're talking about a full portfolio, that's where I get really, really concerned. And so we have to change the conversation to, I'm not worried about if the markets are going to come back. What am I paying you for? Why do I have you as a trusted advisor if you can't incorporate strategies that can deliver positive returns in negative markets or protect principal in negative markets? Because yes, there's cause for concern. So, there's a lot in the world that's going on, and, we just have to now more than ever plan for the what ifs. And I think that's what differentiates us. So 630-492-1912, 630-492-1912. If you'd like to have a conversation, set that up with Paige, and we will do that. So more after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. Thank you for joining me this Saturday. This is our last segment of the show. Hopefully you have found something actionable in the first three segments. That is my goal. My name is Robert Kuhn. I'm the president, founder of Kuhn Capital Partners. I'm also the host of this radio show, Destination Retirement. If you hear my voice, we can work with you. We do run the show in multiple markets, and we are continuously looking to add to the current markets that we run the show in. So I want to make sure that you understand that if you hear my voice, we can work together. Our job is to make sure that we are doing all we can to provide a level of certainty inside of your portfolio that if and when we see more Mondays like we did a couple Mondays ago when the markets dropped like they did, that your portfolio can handle that your portfolio, at least some of that money, can even make money. And that's the job, I believe, of an advisor. So if you'd like to have an initial conversation, you could give me a call at 630-492-1912. Actually, call Paige, 630-492-1912, and let's set up that initial consultation. So fiscal policy, it's election time. If you haven't heard. You probably would have to be tuning out all news to not know that, and sometimes I'm envious of that because I would love to just focus on what I enjoy to do, and family and kids sporting events and coaching. I am a coach, and we do coach travel softball for my daughter, so that takes up a lot of time, but it is also my job as a fiduciary to stay probably more in tune with what is going on in the world than I really like to, because sometimes it's just not enjoyable. But again, that's my job. I owe it to individuals. It's just the nature of the industry. I guess any job that you have, there's always things that are challenging, and that's being connected 24/7 is one of those challenging things in the advice business. Now, I wouldn't trade it for anything. I love helping individuals. I love helping individuals create portfolios that the average advisor simply cannot and will not and does not want to. But that's our differentiation, and we enjoy it. So 630-492-1912. So let's spend a little bit of time on fiscal policy, because I think it's things that everybody needs to think about. And elections, as they say, do have consequences. We talked about taxes, and if taxes go up, what does that do to your portfolio? What does that do if we do see, the capital gains rates, go up to almost 50%? What does that do? And I guess, I thought a lot about that, and that's politics is a purely personalized belief system. And, I have my belief system. You have your belief system. I'm sure we differ on a lot, and I bet there's a lot that we agree upon. My personal belief is that if I knew, and I think a lot of people would, go along with this, but, the debt is becoming an issue. And I had a client ask me this week, what are your thoughts on the debt? And it's so hard to answer that question, because what I think about the debt and what I think the amount of debt will actually do to the markets is two totally different things. And I could get behind higher taxes if I knew that with 100% certainty that money was going down to pay the debt. I bet there's a lot of people out there that would get behind it. But I think if we learned anything with politics is no matter who's in office, they just keep spending. Spend. So let's spend a minute kind of on fiscal policy. And, investors, my advice, at least to investors, is you should monitor the growing dominance of U.S. fiscal policy on markets. And certainly here in the second half of 2024 and beyond, we've seen what future fiscal policy could have on debt, U.S. equities, loans, real estate. It's real. And we made a decision in our household that if we don't believe in a corporate policy, we're just not going to spend money at that business anymore. And again, it a lot of people can laugh, and it's probably going to have absolutely zero impact. But at least I feel like my personal beliefs, we're going to support those companies that have those beliefs as well. And I think everybody should do that. And I'm okay with people having different belief systems. That is okay. This is America. Last time I checked, we can have independent, different views and still be friends. That's okay. And, it's, when you look at fiscal policy, I think it may dominate economic activity in the second half of this year and certainly into next year. So I do believe that investors must consider opportunities based on what assets, sectors, fiscal policy influences are going to affect the greatest. That is something that we have to talk about. Now, you don't hear a lot about that on the radio because it's wonky, it's boring, economics, nobody wants to talk about that. But again, our radio show is different. Our radio show isn't just trying to pitch you an annuity or pitch you XYZ strategy. And if you really, really, really listen to radio shows, really listen to the underlying theme, you know what they're selling. You should be able to identify it immediately. And I hope that when you listen to our show that you can't identify it, because we're hard to be, it's hard to paint us into a box as far as, well, they do this or they do that. Or, because I promise you, again, I just know this because I've been in this industry, that the radio shows that you listen to and you reach out to, they already know what their solution is before you even tell them what you're looking for or what your situation is. I just know it. I see the numbers. You know, we're in the industry where I know the radio shows that are on, you know, this station, that I can tell you within a very pretty, you know, close range of how much business they do and the products that they sell. And it's always comes down to these darn annuities. And it just is crazy to me. But I hope that when you reach out to us, or if you even consider reaching out to us, that you can't paint us into a box and say, well, they're going to do this, or they're going to recommend that, or they're going to, you know, do this. You know, to a hammer, everything looks like a nail, right? And we're just different. And I have people tell me to be more broad-based, to be more general on the radio. It'll get more people to reach out. And I'm like, I don't care about that. I mean, do I want to grow the business? Of course I do. I wouldn't be doing the radio show if I didn't want to have, you know, continue to help individuals. But I'm not going to change the way that I do radio or that I do dinners, because if somebody's going to take time to listen to me talk, or come to a dinner to listen to how you can greatly reduce your taxable income or generate, you know, maximum, you know, income, even if the markets are down, I owe it to them to give my honest opinion. And it may confuse you, because these strategies are strategies that are complex. They're strategies that are not marketed between a football show, a football game on the weekends. And I'm okay with that, because I don't care if it takes me teaching you, educating you on strategies. That, to me, is the job of an advisor. If you can fully understand your portfolio, you have very little risk, true proactive risk management in your portfolio. You just don't. The only thing that you're going to have that is supposed to mitigate risk is bonds. And up until recently, you know, how has that worked out for you over the last 4 years? Not well. So if you're working with an advisor that gives you a risk tolerance questionnaire and says you're a balanced investor, you're a growth investor, you're a this investor or that investor, and that equates to 70% equities and 30% bonds, or 60-40 or 50-50, and that is so cookie cutter, so basic, that you just have more of the same. You just have a portfolio that is going to do nothing more than ride the market up and ride the market down. And that should not be good enough for you. And it absolutely should not be good enough for you in this type of a market of the potential what ifs. Because yes, I do believe there is a possibility that we could see the markets drop in the next year or two by 20% or 30%, without a doubt. That is my belief, that possibility, that probability is probably higher than it's been in a long time. Now, again, the time to plan for that is now. Because if you have an advisor that just says, just sit and wait, it's going to come back, nobody's debating that. Now, it could take a long time to come back. Like I mentioned, always, you know, you bought Microsoft in 2000, took you to 12 years to get back to even. That is very nerve-wracking for a lot of people. So it's not if the money's going to come back. But again, where you're at in your life stage, it could cause a lot of stress if you're, you know, near retirement, in retirement. Those are from those, you know, stress you don't need. But we're not debating if the market's going to come back. We're debating that if the markets do drop 20% or 25%, you're going to use those future gains of, you know, 25 to 30% just to get back to where you were. That is what I'm concerned about. And I want to make sure that we're helping individuals who are worried about that as well before we see potential volatility. Maybe we won't. And I would love that. Maybe we won't. Maybe the markets will continue to go up forever. Maybe we'll see 15 to 20% growth for the next 10 to 15 years every single year. And that would be phenomenal. So if you can look at some of your risk managed strategies and know that we can still get close to or even double digit returns if the markets are down to a certain point, man, we're adding value to a client's portfolio. And that's all we're here to do. We're here to add value to your portfolio in a way that I'm highly confident the current advisors are not adding value. And that's a job of what we do. I think that's the job of any advisor, and it's something we're going to continue to do. So I want to thank everybody for listening to the show. Have a great weekend. Again, if you want to have a conversation this week, just reach out to Paige, set that up, 630-492-1912, 630-492-1912. Hopefully we have the opportunity to talk soon. We'll be back next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.